Hello and welcome to our quarterly update for audit and accountancy. Nice to see you again and Happy New Year. My name is Jeremy Williams and I'm joined by David Smith. And we're going to be talking about the latest developments in accountancy and in audit. The kind of things that have taken place over the last few months, and I guess we're both CPD lecturers, so the kind of things we're meeting on courses and dealing with telephone queries and so on in the office. So should we start with accounting?
Yeah, let's start with accounting. Relatively quiet 3 months, to be perfectly
It has
honest,
been,
thankfully,
yeah.
Given all the real change that's happening in practice at this point in time. Quite
true.
nice to have a period of relative stability compared to what we've seen over the past couple of years.
Yes.
Albeit there have been a few changes coming through the accounting.
We've just had an
side.
amendment, haven't we, to FRS 102?
Yeah, relatively minor amendments to it, both FRS 101 and FRS 102.
Yeah.
If you remember with the old FRS 102 essentially, that the non-small entities will have been implementing over the past 12 months or so. We had this difficult requirement to comply with around if, say for example, you were a subsidiary within a group, UK parent, etc., preparing group financial statements. You had the ability to claim exemption from preparing a cash flow, from putting certain financial instrument disclosures in the accounts, from certain related party type disclosures. But in order to go through that process, you had to send a notification to your shareholders and basically ask for permission.
And people haven't been doing that. I mean, I've noticed when I've mentioned that on courses, you can see some raised eyebrows and people thinking, oh, I thought to miss out the cash flow statement, all I had to do was make a reference to that in the accounting policy.
Yeah, that's
note
right.
and
Very much in the same way that
permission.
you might have done under FRS 1.
Yeah.
But certainly I've seen that as well from a file review perspective. You go looking for it. You ask the question, have you asked the client about whether they've done this? And it's almost blank faces. And so the FRC, in fairness, have acknowledged that people weren't doing it. It was a bit of an arduous requirement. It wasn't really adding much value. There's already a process in place if people have got issues around the accounts that have been prepared for them as a minority shareholder. So, you know, what's the point in putting in place additional red tape to take those various exemptions? And so the amendments that we've seen made with effect for periods commencing on or after the 1st of January 2016 mean that you don't have to go through that approval process. You still have to put disclosures in your accounts that describe the exemptions you've taken within Section 1. And again, just for clarification, this isn't Section 1A for small entities that we're talking about. We're talking about non-small entity, full FRS 102 disclosures with reduced disclosure within it. Slight simplification to the process insofar as you disclose going forward, but you don't have to go through the rigmarole of asking for permission.
I suspect that effective date is going to catch some people out, that effectively we're waiting till, you know, a further period before we're going to bring that in. It's not an immediate effect, and so we're going to have to wait.
No, that's fair. I mean, I suppose those businesses that will have done it already will probably have taken a view from a legal perspective. They were okay just doing it once anyway. Those that haven't done it will be on their second reporting cycle for, say, a December 16 year end, and therefore will drop out of it. And so if they didn't do it last time, there's not likely.
But I imagine there'll still be a fair few September 16 year ends floating out there.
No, agreed. I can't remember whether there was early adoption provision within there. I didn't see it. No.
Okay. So, thankfully, apart from that pretty minor change, it's been pretty stable, hasn't it?
Yeah, from an accounting perspective, I mean, we're at the point of recording this, we're expecting imminently the publication of the LLP sort, and so by the time this is out, one would expect the LLP sort to be out and updated with its revised scope and whatnot. But more on that in the next quarterly update, really. Because
the fact that it hasn't come out, we haven't come out with big changes. We're at the point now where we're just awaiting the real impact of this for small entities of dealing with FRS 102, Section 1A with 105. For many, for the first time, they haven't been early adopting the new legislation. So it's the next few months, isn't it, when they're going to be preparing the accounts under a new regime.
This is real now. The new company law regime is kicking in for primarily your December 16 year ends onwards. With that, we've got increases to accounting thresholds, increases to audit exemption thresholds, changes to the small company qualification criteria rules that flow through both of those regimes. And then, as you say, the updated suite of new UK GAAP standards for those smaller micro entities, meaning that there will likely be more attraction in the use of FRS 105 and Section 1A will be the prime accounting standard for those other entities going forward.
And I think it's fair to say that's been the bread and butter of a lot of our courses over the last few months. And I think a fair few of the queries that we've had
Yeah,
as well have been on issues, on qualification issues, and on practically what do these accounts look like.
Agreed. And the new terminology as well that's floating about, whether it be legal terminology such as abridged or slang in the context of filleted and whatnot.
Is that not a legal term, filleted?
Don't start.
Okay.
On that one. We'll come back to that.
Okay. So let's just talk about some of the queries around those sorts of issues, because we've talked about a couple of queries that we've had about whether property companies can qualify as micros.
Yeah.
And it's around this particular prohibition, isn't it, in the Act about investment companies?
Yeah. So I mean, if we take it back a step, we've got clear qualification criteria that sit within, say, company law or the LLP regulations, as they now are, that say you've got to be small, and that's your starting point. You've got to be small. Yes. There are then certain entities that are just outright scoped out of then the micro entities regime, and as you say, things like investment companies, things like charities, are scoped out, and then you get onto are you in a group and included within a set of group accounts? If so, you're out. Do you qualify by virtue of the size criteria, which we'll talk about in a minute? But in particular, we've had some queries recently. I've taken certainly one. You've taken some as well around what is an investment company. Yeah,
I think it comes in because a lot of the examples that we use when we're talking about potential micro entities are property companies, or companies that have got one or maybe a small number of properties. For the size they are, it's probably not they're not going to be vast.
Yeah.
And that's their main business.
Yeah. And the issue with this investment property scope out, or not, sorry, investment company scope out, is that it isn't clearly defined within UK company law. It's a cross-referral effectively back to the EU directive from which it came. And that EU directive is talking about businesses that are really wholly set up for the purpose of managing risk, really, within those investments. But it's not clear in terms of whether that would apply to an investment property company with various different properties within it.
I think common sense would say if you're just, to be clear to anyone who's confused about whether this will apply to a typical very small company that's got a small number of properties. If you've got one property or a small number, and your business setup is to trade by acting as a landlord for those properties, and earning the rental income from those, then we're not talking about you. You're not meant to be within the scope of that definition of an investment company. An investment company is spreading risk, as you say. So a lot of these are venture capital firms and larger kind of open-ended investment trusts, which will be investing in property alongside investments on stock market and units and so on. And it's that kind of business that the definition is aimed at. But as you say, the fact it's not clear means that if you are a property company with a number of properties which are potentially different in terms of the risk profile that they have, it might be wise just to think about that definition, and if necessary, I guess get specialist advice on whether the company falls into that definition. And there's an association of investment companies, I think, which list, I think they say there's over 400 investment companies in the UK. So they seem to have in mind a fairly clear definition and a membership, I guess, to the association. And that's not the legal definition, but I think that's a good guide, isn't it? I guess if you're you're either a member of the AIC, I think it is, or you're the kind of business that's likely to be considered for membership, then you're in view here. And if you're a regular common or garden tiny property company, then you're not.
Yeah, no, agreed. And then by virtue of that, you're then looking at, as I say, the size classification criteria. And so if you are an investment property company that is holding investment properties, maybe in the past under the Frizzy was holding them at market value, then it's not that market value that's the relevant number when you're assessing against the size criteria.
And I've been asked that a few times, exactly. Can you effectively convert down first of all and look at the cost figure? And
that's what you have to do, essentially, isn't it, in terms of working out whether you qualify for micro exemptions. So you're then looking at your 632,000 turnover figure, 316,000 gross assets, and less than or equal to 10 employees. And so these investment property companies, even where they might have quite a decent sized portfolio of properties, because of the rental yields on certain properties, it might be a goer for them in terms of the micros regime if it works for other reasons, depending on external interest in the accounts, etc.
Yeah, absolutely. And we've been talking about that on our courses, haven't we? That there's a whole raft of very pragmatic issues, and when deciding whether if you appear to qualify for the micros regime, whether you should take that regime or not. And I can think of a number of companies that, when you look at their accounts and the fact that there's very limited use of the accounts, and very straightforward business and so on, there's no particular financing needs, they're not looking at their credit rating particularly, then it may well make sense. For other businesses, it may well not make sense. And I think the feedback I'm getting on courses is it's kind of credit score is an area of nervousness for some people, because it does matter for some, doesn't it?
Agreed. Of course it does. I suppose that the counter argument to that with the micro entities regime is to then say, well, okay, did you file abbreviated accounts last year? And if they filed abbreviated accounts last year, there won't have been that much information in the public domain. Now, it's worth noting there will have been more information in a filed set of abbreviateds than there would be in a filleted set of micro accounts. Unless you decide to put more in those micros accounts. So I was looking at a couple of sets of micros accounts that have been filed recently, and rather than just disclosing current assets on the face of the balance sheet, they had broken that down such that what was actually filed then was more or less equivalent with what was filed last year. And so entities, I suppose, with issues around potential credit rating might be thinking, well, okay, look, I have this availability of an option under the micros regime to include gratuitous disclosure on the face of the balance sheet. So to break that current assets down into the stock, into the cash, into the debtors at a high level without going into that much detail, like you wouldn't have done in the filed accounts last time round. Well, that then means is you're filing broadly equivalent to what you would have filed under the old regime, even if you were a small company filing abbreviated accounts. And then people were having to come to us or come to the business to ask for more information if they wanted more information anyway. And so you give them more information, and that includes management information. And this micros regime will make entities think about, certainly in year one, okay, how much do we need to disclose in our accounts for the genuine users? Do we have concerns around things like credit score? But it'll also make us think, right, what's then the management information that we can give to these third parties that we want to borrow from, or that we want to extend lines of credit? It's thinking more about the package.
And if you've got a relationship with a particular lender, then that's the thing. You will be probably already furnishing them with more information than would go into any set of statutory accounts. And they'll be making their own assessment, which will be partly based on the accounts, but they'll be doing their own appraisal of property values and so on, if that's critical to them, continue to lend money to the company. But I think it's a good point. So 105 allows you to add more disclosure, and because I've been kind of saying, why would you do so on courses? Because I think for most micros where there aren't particular issues, you wouldn't expect them to be adding gratuitous disclosures, but by all means, yes, you can do so, and if you can see a compelling business reason to do that, and you still benefit from the fact you're a micro, so you're not fair valuing things. You've got simple accounting treatment, a very simple standard to use with lots of nice bits of familiar frizzy style accounting in there. I still think it's a compelling reason.
I mean, it's my favourite accounting standard at this point in time.
I was going to ask you that question later on, so you preempted that.
Preempted the question. It is very much point and shoot. It is the only standard within the new UK GAAP that is written for the entities within the scope of it, in my view.
Exactly.
And, we have within FRS 102 now the smaller entities brought within the scope. It wasn't really designed for them initially. We've then got the non-small entities within that scope, and there's compromises in there, and again, bits in there that aren't quite written for the real big boys. You get 105, which is a very stripped back version of FRS 102, which, with, as you say, familiarity from the frizzy sprinkled across it as well. It's very much a...
And they didn't need to do that, really. There were certain legal things like not fair value revaluation, which they needed to bring in, as they did in the frizzy. But they reined back a lot more than they actually had to create a standard that's workable. And
agreed.
I'm finding firms who say, they book me for in-house courses and then say, don't talk about micros because we're not doing micro entity accounts. And I just think, I don't think they've thought that through for themselves as a practice. and B, it's none of their business really. It's up to the clients of theirs to be informed and to make informed choices. And I do think it's a good standard for many of them.
Yeah, agreed. I think that comes from where the micros regime has come from, insofar as it was seen to come out of a very shoddy consultation process, which undermined what it eventually became, to be perfectly honest. And it has now developed and matured a little bit. The FRS 105 is a little crude in a couple of areas. It will develop over time.
Sure.
For example, investment properties, the accounting around investment properties, the suggestions within it for depreciation and the like. Well, okay, that is in line with law and what it says, but it could develop in those areas, and it might do in the future. But at the minute, it's a little crude. But we've got a standard there that is on the whole decent, easy, straightforward. And that's what a micro entity needs. And as you say, I think that the firms that were previously thinking about that, and certainly I've had conversations along those lines as well, where I've said, well, are you sure? It might be the best answer for some of your clients. And once you start to talk about the micros regime and compare contrast to FRS 102 and Section 1A and start to think about different scenarios, there is a clear bracket of clients that will fit firmly within the 105 mod. The others will be a 1A adopter. So, and it's about giving the client the choice. And telling them what their choices are. We can't make the choices for them.
No, absolutely. So should we talk about 1A of it? And I guess FRS 102 more generally, because of course, in terms of accounting recognition and measurement, it's the same standard, isn't it?
Yes.
Bar a couple of transitional options.
Yeah, and those transition options that are available to small entities, so the additional 3 that sit within Section 35 of FRS 102, how often are we going to come across them, I suppose, is the main question there. There are certain types of business. I used to work with a lot of business that had a lot of what you would call equity settled share-based payments who were small, reported under the FRISI. It was pretty straightforward to deal with under the FRISI from a disclosure perspective purely. Those entities I could see looking at the exemptions within Section, or for a Section 1A small adopter of FRS 102 and saying, right, we'll have some of that. You've then got related party financing transactions, which again is limited in terms of its application, financing, financial instruments that have got to be held at fair value, again a transition exemption, but limited use and limited scope, to be perfectly honest, for a smaller entity or for smaller entities more generally. So you've really only got that in terms of recognition and measurement simplification, and that ain't a lot, and that isn't going to apply to that many businesses.
And exactly, and otherwise it's the same standard, isn't it?
That's right.
So, I mean, FRS 102 itself is getting quite long in the tooth now, isn't it? We're kind of staring ahead at the next triennial update, which isn't that far away. But, because many people haven't yet implemented the standard in full, there are one or two issues. I mean, it's important to say, I think, that for many people there haven't been transitional issues. Some people have claimed there weren't any at all, and that's because they haven't done the accounting properly. But I think in some cases there genuinely aren't any differences between your treatment under FRISI and treatment under 102, 1A. But there are issues that come up, and I think the most prevalent issue that we're getting queries on, certainly that I'm fielding queries on, is still the kind of non-market rate loans, intra-group loans, shareholder loans to companies, and exactly what terms these should be in. And some of that I don't think is actually 102 specific. It's thinking about what people have done in the past, and it's revealing the fact that people have been pretty lax about classifying loans properly according to when they are due and payable, and really not thinking through the treatment about interest.
I mean, what we're getting at there is saying if something was legally repayable on demand in the past, then FRS 102 hasn't all of a sudden changed the legal basis on which it could be called. And in the past, many of us, I'm sure, will have prepared sets of accounts where we've classified things as greater than 1 year, and I certainly was guilty of that, if you like, in practice. Without that necessarily being the legal basis as to what should have driven the disclosure. Certainly FRS 25 was a little clearer on that when that came about. FRS 102 really just echoes insofar as to say, well, look, if you don't have an unconditional right to defer the settlement beyond 12 months, then tough. You are looking at a present obligation. It falls within 1 year as a liability. And I think that has been brought into focus by the off-market rate accounting within FRS 102, but that is not an FRS 102 issue.
No, exactly.
But what it does bring into focus for some businesses is, okay, well, what paperwork have we got in place? What contracts do we have? Do we have a contract? And I think, to be fair, what we're finding in practice is that most of these lending, say a shareholder loan into a business or a lending from one company to another company within the group, they don't have formality. No. In general, and as a result of that lack of formality, the normal UK legal position would be to see that as repayable on demand. If you think that there is something quirky with what you're looking at, again, it's the type of thing that is driven by the legal basis. Yeah, there
is a challenge. I can understand why people are naturally upset at that, because it does seem to be a clash between a legal requirement, which I'm perfectly happy with, and them saying, but in substance, we knew when we took this loan on that we weren't going to pay it back within a year. The parent company who lent us the money has always understood that we would never probably lend it back. They just didn't formalise any terms that we can point to say that gives us the unconditional right to defer for more than 12 months. And you can see why people are frustrated at the fact that they might have to disclose and should have been disclosing and classifying these loans as due within a year. But as you say, that's always been GAP, or certainly at least for recent past. You should have been treating loans in that way consistently. And if your understanding was different to that, then you should have been documenting that. Now, I've got a degree of sympathy with people who make the argument it's always been an implicit part of our contractual understanding between us that it's been a long-term loan. We just haven't formalised that in a document. And there's potentially some leeway for them to say, well, we codify down what the understanding is now. But I still think if you didn't have that agreement in place previously, and you can't rely on some kind of verbal agreement to see you through, it's pretty difficult to make the case to say I'm happy with keeping my comparatives as they are during more than a year.
Yeah, agreed. I think that if you have a situation whereby it was an undocumented loan, the basis behind it was, okay, we're not going to pay you back for donkey's years because we don't have the money to do so. Then sympathy with that type of scenario. The issue comes with very specific terms which try and enforce prudence. And in the context of that liability, at least, the borrower is having to show the most prudent position there. And the most prudent position is I could have to pay the full amount back, worth the full amount back today. If they were to renegotiate to put a market rate of interest on something or to define a term, then there can be an argument in a lot of cases that actually what you need to do then under FRS 102 would be to say, well, look, let's get rid of the old financial instrument, de-recognise, put your updated financial instrument in, measuring it in accordance with FRS 102's terms, and you'd very likely set terms of the instrument that wouldn't need you to discount. But the point you're making there around, well, what about the comparative? Well, the instrument has at the comparative balance sheet date was the instrument then, so you still end up with a less than 1 year to greater than 1 year. Whether that is quite so sensitive, because you've already presented last year's old UK GAAP accounts, unless you're going to correct, which you would be correcting an error, I suppose, in classification when restating. But who's looking? The current year figures are likely to be more pertinent, and if you've renegotiated the terms or put some proper terms in place, then they're driving the classification and the measurement as of this year, then okay.
I think it's partly a disclosure issue historically and presently as well, to make sure that loans are disclosed properly and their terms and the kind of the salient features of the loan are disclosed in the accounts, so that someone reading the accounts can understand enough about the loans to make sense of those.
And the issue you have with a small adopter is probably amplified a little bit to the position with a non-small adopter. I suppose if you're a non-small full FRS 102 adopter and you saw this as a significant financial instrument, you would be putting enough in the account, you'd be required to talk about that instrument and its terms, enough such that someone got the crux of what was going on. if you're a Section 1A adopter, you don't have that same level of requirement around the transparency of the terms for this type of financial instrument. And so if
we're not talking about a fair value instrument where you would have to,
right.
under Section 1A,
no, that's right. Talk about how you come up with the fair values. But essentially what you're saying with a discounted loan or an undiscounted loan repayable on demand, under Section 1A of FRS 102 is, well, maybe you would want to say more to show a true and fair view, which then gets you into a whole raft of additional things that you might talk about in a minute. But you might want to, even where it's still classified as less than 1 year, have a note in the accounts or within the accounting policy note, describe why you don't feel it's going to get called within 1 year. And that might be important for justifying your going concern assertion to a user of those accounts. And that's where your support letter comes in as the basis for backing that up. But there's more of a clear designation between that current liability and then bolting on additional disclosure. Certainly where it's under the full 102 regime, because it makes you do it, doesn't make you have to think about whether you need to do it or not. The other issue, I suppose, around the informal type agreement where people are still trying to push it into greater than 1 year is you can't have your cake and eat it. You know, if you are saying, well, something's not going to be paid back for a very long time and we've got paperwork to back that up, say, it falls more squarely within Section 11's type.
Your present value.
Financing present value. And that is something that businesses have been looking to avoid, certainly for historic type transactions, because of potential tax consequences, because of the accounting consequences, and because of the very idea of doing that not really sitting very well with accountants or probably users of the accounts either. To be honest, it's been seen as something that doesn't add a lot of value. And
that's putting it politely, isn't it?
The
comments that we hear.
Yeah, that's right. And it's an unfortunate byproduct of piggybacking onto international standards in that particular area, albeit with relevant amendments. But it's just it doesn't quite sit right.
And we've talked on these updates before, and of course on courses, about the kind of 13-month, 53-week loan. And I've started to see it coming through. I've started to see more firms saying we're doing this now with clients. Obviously, it's the client's business, but they have decided to formalise terms, agreeing that repayment is on a rolling basis, fractionally during more than a year. To get around this issue while interest rates remain low, that we can justify that it's not material to discount over such a short period, but equally it's right to present that as a long-term liability.
And it's that clarity on whether it is a material adjustment. You know, if you have a £1 million loan from a shareholder to a company, and the reason they've made the loan is because no one else will lend to them, then what is the market rate of interest or an equivalent rate of interest for an equivalent instrument lent to that?
Is going to be high.
Exactly. And so even over a year and a day, discounting the difference between 0% and 3,000%, just to pluck a number, is a ridiculous figure. And so are you looking at something that honestly is a loan, or realistically, is it actually equity? And
we've had a number of queries where the conclusion is it's equity.
No, that's right. Given the very nature of it, and when you discount it back, you come back to a kind of very, very small amount, and it's similar in process to what we went through, I suppose, when FRS 25 came in, when it made a lot of people think about certain debt instruments, certain equity instruments that they had, and have to think about whether there were elements or components of debt or components of equity within them. What you see within the financing transaction scenario is something akin to that, but really from the other angle, isn't it? It's kind of looking, rather than something that would normally have been an equity instrument, and you're thinking about it, you're saying, well, look, here's a debt instrument, let's have a look at this. And FRS 102 is saying, what's the substance of what's really going on here? And it's getting you to account for that substance, which is slightly contradictory to what we were saying earlier on in terms of the classification.
Legal form for classification and substance.
Otherwise,
that's right. It's nice to have things to talk about on courses, isn't it?
No, it is, and it's been an interesting kind of autumn run as people have started to really get their crosshairs into onto FRS 102 and FRS 105 because it's really real now. You know, at the time this goes out, it's being used in practice.
Yes.
People will be relatively early preparers of Section 1A accounts and FRS 105 accounts, and there's nothing to focus the mind.
No. Exactly.
Better than having to do it actually, and it's real, isn't it?
I think it's fair to say our early reviews of compliance with FRS 102, and which has mainly been non-small clients because of the nature of effective dates, it's been mixed, hasn't it? So I mean, there's a number of companies who haven't experienced that many issues on transition, and a number of those have dealt with the relatively few issues there are pretty well in my book. We've also seen some fairly shocking bits of disclosure, either because that's been driven by the software, which people, we all rely too much probably on our software to disclose things adequately, and when the software fails to do that, there isn't the mechanism there to correct that. And sometimes it is just not understanding the standards or the requirements of disclosure. But it's a bit of a bumpy road, and we're not alone in finding that.
No, agreed. And I think that was always going to happen with the software, and we rely on it as our safety blanket. We pay somebody to come up with something that allows us to click a button and spit something out. But it was never going to quite work like that. We had to understand how the software worked. And for anyone that hasn't prepared for FRS 102 accounts over the past 12 months, and will be going into a Section 1A regime or a 105 regime over the next 12 months, need to be understanding fully how the software is going to churn those accounts, because it will maybe work differently in some areas. And if we don't think about that beforehand and we try and do it live on the job, it's only going to end in disaster, to be honest, and we'll get things wrong. And what we are seeing through our accounts file review service is there are sets of accounts that are being prepared where people clearly haven't understood how to turn things off in the software. It's not that the software couldn't do it, it's that we didn't know the button to press. So we're seeing hugely long accounting policy notes. We're seeing FRS 102 transition disclosure notes when there's literally nothing to say, and 3 or 4 pages of disclosure at the back of the accounts saying I'm saying nothing. And that type of thing, teething problems. But I wouldn't want to experience that as a client. And okay, a lot of the time we've been reviewing these accounts, they're effectively hot file reviews. The client doesn't see that, but those are the files that we're reviewing and the accounts that we're reviewing. There needs to be a quality control process, certainly in the early months as we're getting used to where we're pitching things.
Yes, absolutely.
With the small regime kicking forward, because that we didn't have time necessarily to do it over the past 12 months.
Yes, and rejection rates at Companies House have been actually fairly low, but we're not reflecting the small regime. I suspect it'll be interesting to watch that statistic. I would say for the next 12 months or so.
Yeah, and it will take the next 12 months or so. It's not going to be until Q3 2017 that the statistics start to reflect that most people are now starting to file the new small regime accounts, the filleted sets of financial statements that might have been abridged prior to filleting.
Yes.
We'll talk about in a minute.
Okay. I mean, if we've done our jobs properly, then obviously, the rejection rate will be minuscule, won't it?
Yes.
For Mercia firms at least. Should we talk about abridged and filleted accounts?
Go on then.
Bring ourselves to do it.
Yeah, let's.
So let's just be really clear: abbreviated, abridged, and filleted. Abbreviated we can discount now.
No such thing.
Old regime, isn't it?
No such thing as abbreviated accounts anymore. I'm going to have to be very careful not to say the wrong words in this bit. But abbreviated accounts, you won't find it in company law.
No.
For periods commencing on or after the 1st of January 2016, so essentially that tranche of clients coming through the December 16 year ends and onwards, there is no option to file abbreviated, it disappears.
No. So what we file now is members' accounts. That's the key principle, isn't it? Is that what you give to members is the set, at least from which you draw the filed accounts. Now, you have the option to either file the members' accounts as they are, intact, and I do ask people on courses whether people have historically filed, frizzy accounts for small clients intact without any change, and I'm surprised sometimes that I do get nods from that there are some people who haven't wanted abbreviated accounts and they've just filed the full set of members' accounts.
And
as
again,
they are.
it's similar considerations there to that which are about at the minute for whether you go down the micros regime, because it might be better for you to have that information in the public domain than not.
Yeah.
And again, it comes back to questions of, well, have we asked the client, or do we just file abbreviators because that's what we do? Yeah. And giving the client, again, the choice over what is filed. But essentially, new regime, no abbreviated. As you say, we're essentially filing a copy of the members' accounts by hook or by crook, and we'll get onto that in a minute. And that's, that derives from ideas at a European level that they wanted to cut red tape. Yeah. And they look at our legislation as it was, and they said, well, look, you've got these small companies having to prepare members' accounts and then having to prepare another set of accounts for filing. That looks like red tape. Yeah. And they cut it. And the way that they cut that was to say you've got to file a copy of your members' accounts. Yeah. But subject to certain relaxations, which is...
Yes. So to be clear on that, abridged accounts then, which we can talk about in more detail in a second, is a members' accounts option. It reduces the accounts that members get, and hence reduces the accounts that you file because you file the members' accounts. Yep. And so what you can't do is prepare full statutory accounts for the members and file a version of abridged accounts of filing. That misses the point, doesn't it? That it is the members' accounts that get filed.
What we have kind of going forward is a regime whereby you say, I'm preparing these accounts for the members, for the shareholders. What gets filed reflects what is in this set of accounts, whereas in the past it didn't. It was derived from a separate place. It said, here's what you have to have in the filed account. Going forward, what goes in here gets filed, subject to certain filing exemptions. Exactly. And those abridged accounts are an option. They're a valid option for the members' accounts. It's important to recognise, I think, that where law talks about this abridged accounts, it says, well, okay, it's got to be appropriate for the circumstances to your business. In addition to that, there's two, I suppose, sub-paragraphs within the legislation. One of them talks about the abridged profit and loss account. One of them talks about the abridged balance sheet. Yeah. You can abridge one without t'other, and that might be an attractive option. Yeah. If we talk about a normal set of members' accounts adhering to a full Format 1 presentation, say, and you take the profit and loss account, you'd have your standard turnover, cost of sales, gross profit, et cetera, running down, and that would be your full members' profit and loss account. But if you were to abridge that profit and loss account within those members' accounts, you wouldn't be disclosing the turnover, you wouldn't be disclosing the cost of sales, you wouldn't be disclosing the other operating income. It would just get consolidated into a single line. Now, the process for that is such that all of the members have to have consented to you doing that. Yeah. And they have to provide annual consent. That consent has to be received after the year end, but obviously prior to the point in time that they approve those actual accounts. Yeah. And so, again, there is a process to get in place if we are thinking that we are looking at abridged profit and loss accounts and or balance sheets. We need to get a process in place such that the clients are aware they need to an element of formality here.
The question is for many small companies then, do they use their statutory profit and loss account? Because I think many of my clients who I was in practice never looked at. I suspect some of them never knew that there was a statutory profit and loss account. Yeah. They assumed somehow that there was a balance sheet in the mix somewhere, which they never tended to look at. And then there's a detailed profit and loss account at the back, which, as we know, is non-statutory. But that was the document they would turn to almost by rote when we had a wrap-up meeting, because that's what they're focused on. So, if they're going to look at the statutory P&L for themselves as members, they might choose, well, let's not abridge that, and let's just confine the abridgment to the balance sheet. But I'm still not convinced that
I'm not convinced with an abridged profit and loss account. I don't think if I were in practice, whilst we talked about the process there, I don't think I'd be doing it. I don't like it. I don't feel it gives me a true and fair view. If I were a user of those accounts, I kind of need to know. If I'm looking at a bottom line profit, I've got to know how hard you work to get there. Yeah. And if I don't have the turnover or the income figures in that profit and loss account, I'm really not getting the full picture. Yeah. And for me, that is a big issue. And Section 1A within Appendix A to Section 1A of FRS 102 talks about that abridgment and says, well, look, guys, does that show a true and fair view?
Mm-hmm.
If not, disaggregate the things you're aggregating in a note to the accounts.
Yeah.
What's the point? What is the point? When we get on to filing, we'll talk about that in more detail in a minute, but there's no point.
Mm-hmm.
The abridged balance sheet, what that does is it offers some businesses who are small, don't qualify as micros, filed abbreviated accounts in the past, and we'll get on to why in a moment. It gives them the option of endgame filing something which isn't too dissimilar to what they filed before. Yeah. Now that doesn't make it right, but it makes it a bit more attractive to some businesses, because what it will do is it will strip back your debtor's note, strip it out almost. It will strip back your creditor's note, effectively again strip it out. Less detail on fixed asset movements. Now that, again, will need considering from a truth and fairness perspective, but if that, or a copy of that, is getting filed, then that is less than what would have been filed if I were following the full formats.
Yes.
And that is potentially, I suppose, if I were a client, what might be attractive to me if I was attracted to the abbreviated accounts regime because I knew it was an option in the past. It might be that actually, within my shareholder accounts, do I really need those notes? Yeah. Do users of my accounts really need those notes? Yeah. And if you're looking at a relatively private business, not a lot of interest, it's normally the creditor's note that will break truth and fairness on this, if we're honest, I think, then not a lot of external interest, not a lot of borrowings, then, okay, could we make an argument that just disclosing creditors is okay?
I'm pretty comfortable with that,
And certainly, again, if I were a client and, say I'm a director of that company, it's my job to sign off that they're true and fair. Yeah. I would be happy signing a representation to that effect. Yeah. And, from an accounts prep perspective, I think that might be a goer.
So abbreviated as was a Companies Act term. Abridged accounts is a Companies Act term in the sense that you can abridge your profit and loss, your balance sheet. Yeah. And then we've got filleting. Okay.
Yeah, that is not a Companies Act term.
No.
That is dictionary defined as removing the bones from a piece of meat or fish. Right. So that's what filleting is. Yeah. So would you like me to talk you through that process?
You don't need to talk about filleting steak.
Okay, I'll talk about filleting a fish. Okay. Okay, so I've got a fish. Okay, right. Decent sized fish.
Can't believe we're doing this.
Okay, it's like a cookery class. I take its head off. Yeah. Right. I don't want to eat it. I'm just going to throw it away. Okay. Okay. I open the fish up. I remove the bones. Yeah. I pull the spine out. A couple of little bones.
If you're watching this at lunchtime, by the way, you might want to tune out at this point.
And essentially, what I have there is a fillet. Now, no one likes a fillet. Just like so, I've got to season it. Yeah. Salt, pepper, whatever, and then I'll cook it. Yeah. That's filleting. Yeah. Now, why are we talking about that? Lord only knows. Well, if I take that set of members' accounts and I chop its head off, and that is my director's report, and I pull out its spine, which was its P&L, and a couple of notes to the P&L, I season the balance sheet with a couple of disclosures that say I'm filing my accounts in accordance with the small companies regime, and I haven't filed my profit and loss account. Then what I'm left with there is a fillet, and it's that fillet that goes to Companies House. Now, if I don't season it with the relevant balance sheet statements, Companies House won't like the taste. They will kick it back at me. Yeah, I'm sorry.
You've done this before.
Yeah, and I've got to be very careful with that statement. Now, that fillet, do I have to write fillet on it so that people know it's a fillet? No. Essentially, I would not call it a set of filleted accounts. It is not a legal term. I wouldn't want to do that. Albeit Companies House, I think, have suggested that, you might want to call them filleted accounts on the front page. Well, really? I mean, we used to call them abbreviated accounts because that was the legal filing regime. What I'm doing is filing accounts in accordance with Section 444 of the Companies Act 2006 as amended by Statutory Instrument 2015-980. Right. It's quicker to say filleted. And that's why people are describing
as to where the watercress sauce comes in.
I mean, you could send that in. I don't know where that would fall under the Bribery Act as to please don't reject these because of all the other things that are wrong with them. But essentially, I'm taking my full set of accounts, I'm filing bits of it. most of it. I'm just taking the stuff out that I don't want to
Yeah.
file. Which again links back to, well, if I abridge my members' accounts and decide to fill it when filing, because the fish is smaller to start with in that set of members' accounts, the fillet is smaller. I can't stop. Why have you done this?
Yeah, I know.
Okay, so
Yeah.
you know it's and that is something visual to think about when we're filing, when we're describing to clients why the filing is changing and how it's changing. We might use that terminology around the office, but you know, essentially it's talking about section 444.
So it's a filing regime only,
Yes.
absolutely critical. You can't give members' accounts without the statutory P&L on because there's not an option for them. It's a filing option only.
Yep.
I guess for lots of people who are used to abbreviated accounts where we didn't include a profit and loss account or a director's report, again, it helps them to get a more familiar looking set of filed accounts compared with what they had. It isn't abbreviated, and that's particularly important on things like additional disclosures. If you decide that there's an additional disclosure which is needed in the accounts to make them true and fair, then you can't automatically remove those in the same way that you could have done in abbreviated accounts.
Again,
I guess if they're profit and loss related,
agreed.
then they're part of the thing that gets filleted out. Was it the spine or the? Yeah, it was the spine.
It's the spine of the fish, isn't it? It becomes a bone that would get caught in your teeth.
Well, they're the fins, aren't they?
Well, don't.
Sorry.
Anyway.
But yes, so that's a difference still. We're not saying that you've got a fixed set of disclosure notes in the way that you did with abbreviated accounts, but we are saying, look, these are similar enough because there's no director's report, there's no profit and loss account, we've got a balance sheet, which will either be full or abridged depending on what decision you made for the members, and then we've got a set of notes.
Yeah, no, agreed. And again, that filing the copy is what is important, comes from that European law, drives through our Companies Act now in section 444, the bolt-in, the change really within that section from where it was in the past, which means that if you put something in because you're saying you need it to show a true and fair view, it's part of the members' accounts, the individual accounts, and therefore gets filed.
Just, we could rant a bit on truth and fairness, couldn't we? But I do think this is still going to be an area that over the next few months we're going to see lots of people grapple with in reality, because I've been asking groups certainly whether they have ever added extra disclosure to a set of frizzy members' accounts on the grounds that they didn't think they were true and fair as they were, and it happens rarely.
Going concern is your one scenario where the frizzy will have said material uncertainties that cast significant doubt, but you will have felt on occasion, and you'll have followed guidance issued by the FRC back in 2008, 2009, that said, look guys, look at that set of accounts, you need to explain why you don't think there are material uncertainties, and that type of disclosure wasn't a requirement, it was the application of truth and fairness in excess of frizzy requirements. And that would have been relatively isolated. The frizzy was otherwise relatively comprehensive, you know, and it looked at lots of different scenarios for your normal, if there is such a thing, small business, that'll normally do.
And so what we're now in a world where we've got a fixed set of statutory disclosures replicated in section 1A, and then this continued encouragement in section 1A that you've got to make sure that these are true and fair, and that means you can't stick to the 13 disclosures without thinking about it. And some people will interpret that as meaning we would routinely expect you to add in extra disclosures on top, that the 13 aren't in some way sufficient. I personally don't like that view, particularly because the European law on which the 13 disclosures are based itself requires the accounts to be true and fair, and it would have been a bit silly for them to have come up with a set that they didn't think were true and fair by themselves. So I think there's got to be at least a fair possibility that with the standard statutory notes you are giving a true and fair view, but equally law's always said if you complied with all the disclosures required by law and accounting standards and that's still not in your view sufficient, you've got to add more disclosure. So we're not left with a frizzy with, you know, maybe one or two other areas in rare exceptions. We're left with a section 1A set of accounts with minimal disclosure or statutory disclosure, and then you thinking about the need to add more.
I mean,
I think what we haven't really seen yet fully is how that's going to work out in the marketplace.
No, I mean,
and whether people will be adding in more disclosures or whether they'll be largely sticking to the 13
what will
statutory
become
notes.
generally accepted accounting practice has not happened yet.
Yeah.
And I think that when you look at, in practice, when you're doing this first set of Section 1A accounts and you compare them to last year's Frizzy accounts, for most of your clients, there isn't really a difference.
It's going to be fairly similar, isn't it?
And there won't be a lot missing out of the set of accounts where you're going to think, I really need that in to show a true and fair view. And it's then a case of having to think, well, look, the FRC is specifically encouraging me in a number of areas, either in aid of truth and fairness or because it's because it should be there, to put more in these accounts. And what it needs is a thought process that wasn't and hasn't necessarily had to be there in the past years. We churn the accounts, we run through a disclosure checklist, that's our completeness check, we're comfortable, push them out the door. There's just an additional process that happens in terms of saying, well, look, do they need more? And I mean, I'm relatively bullish on it.
You've compared the accounts this year under 102.1a to the Frizzy accounts from previous years and said there's not likely to be that much difference. And I'm with you. I think that's a good principle. Is that if we never complained previously, no one ever was really accusing those Frizzy accounts of being defective in terms of truth and fairness, then why should that change necessarily? So I wouldn't expect most people to be building in full FRS 102 disclosures just because of Para 17 of Section 1A, which says we'd like you to consider and provide all these other disclosures that are relevant to material items. Well, I've got something in my accounts which is material. If I was not using Section 1A, as a small company, I'd be disclosing a lot more on that, but I wouldn't have done so under the Frizzy. My gut instinct is to go with an equivalent level of disclosure that I would have been happy with last year, because I think that's what shareholders are expecting, that's what they're used to. Just as a...
Again, I think your link back to the European legislation is an important one, because truth and fairness for a small business and its users of its accounts will need to be pitched at a different level to a larger business with its users of the accounts in general. And that will be the scenario you're working with in practice. You're saying, well, who's using these accounts? And therefore, where do I need to draw the line as regards additional disclosures needed in there? But at a European level, that thought process happened. We've then got, helpfully, stroke unhelpfully, at a European level, them saying, well, look, don't gold plate this. These guys are small businesses. Think about it. What we then had from the FRC probably was unhelpful, with specific encouragements in the way that they've encouraged them in terms of linking it to truth and fairness like they have, or with using the language, the encouraged word. I don't like encouraged. But it's what we're trying to apply. And it means that if we go against what the FRC say in those encouraged disclosures, we feel like we're working against the standard setter there, and I don't find that then helpful.
No, I agree.
I'd almost rather over a blank sheet of paper saying you need to think about whether you need anything else, like your Para 17. You can read that, it's not very nicely worded, but you can read it in one or two ways. You could read it as a signposting paragraph, where for something like your disclosure around the total amounts of commitments, guarantees and contingencies, company law just requires one number. And that might be an area where I would look at that £5 million that was disclosed in the accounts and say, what's that? I need something more there to explain it, that it's an operating lease that runs for 20 years. In order to show a true and fair view. And that paragraph, I could look at that paragraph in Section 1A and say, what that is doing is it's trying to signpost the leasing bit of the standard, where it says, look, maybe you want to break it down. Maybe you don't need all of that. You might do with a narrative disclosure, but very likely in practice you'll just trigger the note and press the button, it will spit out. But then do you need all of that?
So I think there's scope for improvement, definitely, in the way in which the standard handles that issue, that dilemma between standard disclosures, which under law you have to make to present legally compliant accounts, and the need for truth and fairness. And the standard has an approach to that, which I think they could present better and more clearly, and we'll wait and see, I guess.
We'll wait and see. We've got a proposed triennial review, proposed consultations into 2017 now, that we should be expecting to see kind of in the next, well, hopefully 6 to 12 months, that will give us a clearer direction as to what the FRC's views are on the future of FRS 102. And, you know, again, final quarter of 2016, what we had was a bit more clarity on what the FRC's intentions are around things like incorporation of international standards into FRS 102 and the like, and they proposed at least a timetable, I suppose, Brexit permitting, and the implications that might have more broadly. But essentially, they proposed a timetable where they were looking at IFRS for SMEs developments, which is the standard upon which FRS 102 was based. And saying, well, what's changed in IFRS for SMEs? And, you know, certainly there's bits in there that would be really nice to have in FRS 102 at the minute. You know, there's 6 or 7 additional undue cost or effort exemptions that would be really useful, but we haven't got them yet. And they've said, well, let's look at this periods commencing on or after the 1st of Jan 2019. Let's think about getting it in there. Bigger changes around things like leasing. Well, hold on. Yeah, let's see how that settles in internationally, and that's the proposal at this stage from the FRC. It's probably worth just mentioning there's a consultation out on FRS 101 as well around leasing disclosures. Yes. Just for anyone that is applying FRS 101 in practice, most people we've spoken to, I don't think have had a need. No. Been a bit more use of it over recent months. We were talking about some of the venues that we're lecturing in. And hotel groups, certainly big hotel groups owned overseas, etc. A lot of them have adopted FRS 101. So we're seeing a few more businesses adopting that now than were certainly when the law didn't work really very well with it. But for the smaller clients, it's either 105 or 1A, depending on the regime in which they qualify.
Exciting.
No, it is.
Well, should we turn to auditing?
Okay. Yeah.
And audit reports.
Yeah. How do you like your audit report?
I like mine as lengthy as possible. Anything you can do about that?
You're in luck.
Really?
You are in luck. So what we have, and again, it's important just to be clear on dates here. We've got some changes that kick in because of changes to company law. Periods commencing on or after the 1st of January 2016, or whenever we're implementing the company law changes, if we're an early adopter. We then have some changes that are coming in because of the amended ethical standard and auditing standards for periods commencing on or after the 17th of June 2016. So primarily June 17 year ends, say, will be the next tranche of changes. Now the first bit, the changes that we'll see earlier on in this year as we're first starting to push audit reports out the door, deals with narrative reporting essentially. And one of the main changes it makes is around giving a specific opinion around compliance with the director's report and the strategic report with legal requirements. You know, and it was always an area where we used to report on consistency, but the law never really backed us up in those situations where
someone had missed out a chunk of the director's report, chunk of the legal requirements in the director's report or the strategic report if they hadn't covered fair review of business. We didn't have any explicit requirement to
report on that. And I think what they've changed is helpful. Is it likely to lead to more qualifications of audit reports? Well, probably not, but at least that paragraph gives us a better negotiation tool in that process. I think it does. And that's often the way that it tends to work, isn't it?
I think it will help with smallish companies' strategic reports. They're kind of not far above the small threshold. And I certainly tend to see strategic reports which are pretty thin on detail. They're not
full, they're not fair, and that is kind of your benchmark. That is, again, legal requirement, and the updated requirement that will kick in primarily for December 16 year ends forward. That helps. That helps the auditor. So that's one.
And that gets me a slightly longer report, doesn't it?
Oh yeah, no, that's right. Only a couple of paragraphs. You'll be disappointed to hear, but just a couple of paragraphs.
That'll do for now.
That's fine. Right. Okay. What we then have are the new suite of auditing standards that kick in 17th June 16 periods commencing. Now, when the FRC were developing this updated suite, obviously they had changes that derived from the EU audit directive. They had various international audit standard changes, projects internationally around auditing other information presented in a set of accounts, auditor reporting in itself,
so
things like
key
auditing
audit
disclosures,
matters and
etc.
so on.
Yeah, that's right.
Yeah.
And so we saw amendments to the ISAs published, June or so, in final form last year. When those changes kick in, we will see a longer audit report. And there you go. And what we actually saw in again the final quarter of 2016 was the publication of an FRC bulletin. So if we remember back to 2010, we had a compendium of audit reports that had lots of audit reports in it, 40 odd different types of audit report, different types of examples in there. Very nice, useful document actually. What we had final quarter of 2016, an updated compendium that replaces the old compendium with 7 or 8?
Far fewer,
far fewer, 40 or so less examples within it, ranging from small company, say Section 1A adopter for that relevant period, up to your more public interest entity type reporters. But far fewer, less on the specialist side, well, nothing really on the specialist side. The first example, for example, within that bulletin, explicitly shows the application of the updated ISA 570 around going concern and new reporting required around going concern. Changes around the new ISA 700 plus series, which runs from 700 through 720, I think, but with 4 or 5 ISAs in the middle. And what we see there is a change into the format of the audit report, such that first section of the audit report, and I quite like this, first section of the audit report is your opinion. You're just getting down to it. Here's what I think.
Puts it right where you want to see it.
That's right, and that I quite like. But certainly, as I was rolling down this example, small company audit report, and it was going on, and it was going on, and it was going on. I'm starting to think, well, okay, you clarified the ISAs, kind of 5 or 6 years ago now. You've just clutterfied the audit report, because essentially what you then have is, well, okay, here's the basis of my report, here's various other things that I want to say. I've then got a paragraph in there that's talking about other information that says, where there's other information, I'm not required specifically to report on it unless the law tells me to. And you've got this big paragraph that gives you a big disclaimer around other information, when in fact you do have to report on the relevant other information within a small set of accounts, because you're reporting on
report,
exactly. So you've got a paragraph which is really superfluous but is required by all accounts. You've then got a going concern paragraph that says, okay, no material uncertainties, fine. There are going concern, fine. Which you were implicitly saying anyway.
Exactly.
Within an old audit report, and the updated audit report has a paragraph that says it explicitly. Again, that was linked really to a corporate governance code adopting type requirement that was more relevant to them. But the smaller entities will still see additional reporting around it. An ISA 570 is a bit more clunky, I think.
It's important to stress, I think, that we're not expecting more work from auditors on going concern in order to achieve these new reporting responsibilities. It's just opinions.
It's just an opinion that's given. And also, if you do have material uncertainties, I suppose that the process changes. We were used to having to have an emphasis of matter paragraph that referred to good disclosures. That emphasis of matter paragraph just disappears now.
Because it's explicitly there.
Because it's there, and so rather than saying nothing to tell you, you say go and have a look at the note, and specific wording required in that instance. You then get further down this report, and you've got things like the scope of the audit. And if you're cross-referring to the FRC's website, the paragraph is still yay long.
It is. It's surprising, isn't it?
That's right. But if you don't, it's a page long. Where you explicitly lay out the scope of an audit, and you're potentially ending up with an audit report. Oh, and then you sign it, obviously, senior statutory audit, and you're ending up with an audit report that's nearly as long as the accounts. And that's an improvement. I don't know. I like the opinion at the top.
Yeah.
Let's end with a negative on it, positive on it.
Yeah.
I mean, it's got the opinion first.
I can imagine some firms hoping their clients will never read the report saying, look why our fees have gone up, look how much more we've got to do in this in this lengthened report.
Maybe, but it's...
I'm not suggesting that. But
no. But there's no more work that goes into that. It is something that is spat out, but unfortunately means it won't fit on a page.
Critically, what we haven't got though for a small company is key audit matters. So is the kinds of things we've seen in larger listed company audit reports where we discuss things like materiality, we discuss what the risks are on the audit and what our approach is. We don't have that responsibility.
To have it. Yeah. What you find in ISA, what is it, 701 or 701 is it? You find that the scoping of that ISA is actually relatively relaxed insofar as it requires it of your CG code adopters and this, that, or the other, your public interest entities or other entities that wish to report key audit matters. So you could go to town on it with your audit reports as a firm. If you really wanted to tell the client something useful in the audit report, and maybe cut back on your other management reporting in that regard, then okay, there is the ability to report key audit matters within even a smaller entity audit report. Would you? Maybe not. No. So okay, you can do it, but yeah, that made for relatively interesting reading. You're pitching it up against other audit reports here, but essentially, the audit report, a bit more information in those generally bigger type businesses. But for other businesses, even your non-small businesses in general, it's just leading to a longer audit report without it really adding much.
Saying huge.
It's just
extra,
3 pages of risk management statement rather than 1.
Yeah.
And I don't know. I don't like it.
Yeah.
But that is what it is. Other than that, as I say, from an audit perspective as well as an accounting perspective over the last few months,
relatively quiet.
Relatively quiet in terms of the publications that have come through the door.
Yes, and I guess it's just we've got to start to apply our revised ethical standard, our revised auditing standards for those June 17 year ends. Yeah. But that is the meat of the change, isn't it? It's the reporting focus for all of us. Yeah. And then I guess if you're a public interest entity, then I mean you have a lot more to deal with if you're a public interest entity, and there are a lot more firms that are within the scope of the PI definition now. We're looking at 50 to 60 firms that weren't there before, being looked at by the FRC rather than the ICAW or the relevant professional body, and that will be a big difference procedurally to the way that they are looked at. Plus additional ISA and ethical standard requirements in particular that will have implications for them. Broadly speaking, for the others, the ethical standard has been restructured into a single standard. There are some changes. There are some principle type changes in terms of the way it is structured around having some very high level objectives and saying, right, here's what you're gunning for. Which is why why they brought it together into one standard, isn't it? Because there's a risk that you just looked at ES5 as the only standard, as if the others didn't exist, and in particular ES1 was always meant to be a kind of grandfather standard, wasn't it?
That's right.
And so this forces you to say, well, we're applying the standard, I better read the whole thing.
No, it does. All 140 pages of it. And I think that it's nice. I like the principles-based regime at the front that was previously ethical standard 1 that they brought in. What I don't think knits in with it quite well.
Less keen on the rest.
It's the 120 odd pages that you have then after a principle-based standard. You've got principles, but here's a load of requirements you've also got to deal with. And how do the two of those knit? And it's not an easy standard to read.
It's not.
I've been trying to over this week as we've been obviously looking at pushing changes through the audit manual that we have. And it's very, very difficult to interpret. There's a lot of clutter in there. There's a lot of skipping backwards and forth to try and work out the relevant bits of the front section of the standard that it's referring to, because it just cross-refers. And you then step back from it and say, well, what's really changed here? And for most non-public interest entities, non-listed entity auditors, Not a great deal,
No.
I think is the honest answer there. There's been added focus in a number of areas. You know, we talk about contingent fees from a tax perspective, say, talk about
advocacy threats.
Tax advocacy threats,
Yeah.
and removing words really just to clarify something that we should have always thought about if we were always applying ES1 in alongside ES5.
Yeah.
But again, because it's in one place, we do see some tangible change. We'll talk about them more in, I think, the next quarterly update specifically, but the level of change is not great.
The key message to send to firms is we're not re-clarifying the ethical standards. It's not that nature of change. For pies, yes, there are significant changes.
Yeah.
But for non-pies, there's a lot.
And by that, I presume you mean the process. I would not draw an analogy with clarified ISAs with what has been done to the new ethical standards.
It isn't the same depth of change in terms of your practices.
It's not,
in the same way that it was in the ISAs when they were clarified,
Yeah.
or indeed in the ethical standard when it was first introduced into the UK.
Yeah.
You know, that did bring a substantial change to what we'd had previously, and this doesn't add another leap of requirement again, and nor should it.
No, that's right.
We've got enough to comply with already, haven't we?
Agreed.
Well, that's been great. So, trust you found that useful. It's been great to catch up with David again. We've got an awful lot of months now to see how this implements, and I think 2017 is shaping up to be a really fascinating year to see the kind of things that we've been talking about for years now. FRS 102 feels like an eternal project, isn't it? And here we are finally getting to grips with it. So we hope that you survive the process. Please keep calling us for technical inquiries. Please keep turning up on our courses and talking to us about how you're finding things. And please tune into the next quarterly update. Thanks very much.
Good luck.